Welcome to today's webinar. Welcome everyone. Cryptocurrency, the next wave of IRS audits. I am Rosa de Moraes. I am the Director of Client Relations here at Audits, CPAs and Advisors. It is a pleasure to connect with all of you today. Bienvenidos a nuestros amigos que hablan español e bem-vindos aos nossos amigos que falam português. We are delighted that nearly 300 people registered for today's webinar. Audits is planning to host future events on hot topics. If there is any topic that interests you and your business, please feel free to reach out to us at our email info@abitos.com. We are welcoming all of our clients and friends who are just logging on, and we will start in just a few minutes. Today's webinar, entitled Cryptocurrency, the Next Wave of IRS Audits, features Raimundo Lopez Levy of Audits, CPA and Advisors, and attorney Jeffrey Nyman of Marcus, Nyman, Rashbaum, and Pinedo. Jeffrey Nyman worked at the forefront of the United States government's office offshore tax enforcement efforts. Jeffrey Nyman is an experienced trial lawyer who regularly defends individuals and corporations in white-collar criminal litigation, matters involving tax controversies, government regulatory enforcement matters, internal investigations, compliance counseling, and complex civil litigations. Raimundo Lopez Lima Levy is a CPA, also a certified valuator, and a fraud and forensic expert. He's the managing partner at Audits, CPAs and Advisor, where I have the pleasure to work. And Raimundo is an experienced tax advisor to both public and private companies in the United States, with both domestic and multinational operations. As a recognized expert in international tax matters, he has often been called upon to offer expert testimony in both the US and international courts. And before I turn you over to our speakers, please be advised that this webinar is being recorded and self-recording of this webinar is prohibited. We kindly ask you that you post your questions in the Q&A session rather than in the chat. And I now turn you over to our amazing presenters.
Great. Ray, is this me or you? I guess I'm happy to jump in, but thanks for having me.
Yeah, thanks for, no, it's a pleasure. Thank you all for participating, and we look forward to answering your questions and giving you a breadth of knowledge of where we're heading with this topic in the US.
Yeah, look, I think it's a pretty interesting topic. It's obviously very timely. We're in kind of this unique period where I think the IRS is trying to play catch up, and I think they've played catch up, and they're catching up to those who have been dealing with cryptocurrencies for years. And now they're realizing that there's this huge tax gulf or amount of money that probably hasn't been paid as a result of certain income earned from the receipt and the sale of these cryptocurrencies over the years. And we're about to see, I think, a pretty significant wave of IRS enforcement.
Yeah, and I think with the most recent case of the FTX, it's going to require a lot of the political pressure now on Congress to basically come up with rules that safeguard clients in their funds and where they're investing. So I think it's a matter that's going to be evolving as we go along.
For sure. Look, as we are in like where FTX had its arena, right? It's kind of ironic that Miami has an arena named after now one of the largest fraud schemes in the history of the United States, or potentially fraud schemes in the history of the United States. I guess it's a collapse, not a fraud yet. Right. Although there's lots of whispers out there as to what the heck was really going on. And it's going to be some interesting times. I do think that there is tremendous oversight, some tremendous pressure. And I think a lot of folks are kind of looking around within government figuring it, is this my problem or is this your problem? Is this our problem? Who is it that's going to take the lead and step up? And what we've seen, and as Rosa said in my intro, I grew up in the Justice Department. I grew up as a prosecutor in DC and down here in Miami, prosecuting primarily tax crimes, but other white collar criminal matters as well. And what we're seeing now is DOJ's formed a task force. They are looking at FTX. They're going to be looking at these crypto stuff for a while. And the IRS has been pretty aggressive as well in doing certain enforcement efforts. And kind of as I pivot from kind of just opening remarks to kind of just some general thoughts. My claim to fame when I was with the government was going after the Swiss banks. I prosecuted UBS for helping the Americans hide money back in 2008, 2009. And out of that prosecution came information to the Justice Department, to the IRS, that led to waves and waves and waves of enforcement efforts to crack down on undeclared, unreported Swiss bank accounts, foreign bank accounts, whether it was Switzerland, whether it was Israel, whether the Cayman Islands, wherever it may have been. We've seen the government kind of back in 2008, 2009, carrying on still to this day, really kind of figuring out how to crack down on undeclared, unreported secret bank accounts. The crypto wallet is no different. The crypto wallet, I believe, is the secret Swiss bank account of the last 15 years, or maybe even longer, last 100 years. And now the IRS is trying to figure out how to attack or how to really bring into compliance this unreported income that I think is estimated to be north of $1 trillion when all is said and done, just like the IRS was cracking down on the secret Swiss bank accounts. I don't know if you have some opening thoughts, Ray, and then I'll.
No, and I think the fact that they've collected over $5 billion is a recipe for them to pursue this. The other point is it's also a destabilization of our monetary policy. So we're seeing the essence of the ability to money launder, our ability to tax evade, and the ability to move billions of dollars around the world, bypassing our Federal Reserve systems. And this is a recipe for really not just tax evasion, but money laundering. Money laundering is a totally different topic that can be built upon. We're just simply addressing the aspect of the international tax side and the underreporting of income and information reporting. But there's two prongs to this approach, and that would be is the money laundering side as well as the income tax side. So I think it's a recipe that addresses multi-jurisdictional, that's affecting all governments worldwide. So the use of MLATs between governments, the exchange of information between governments is going to become very critical. The implementation, case in point, Argentina just signed an agreement 2 days ago. It's the recipe of what's happening in the next, and people are realizing that the closed doors are going to come in, into play, and the IRS is going to start coming down. Time is on their side when it comes to unreported income. And so what people don't realize is that if you didn't report an FBAR 15 years ago, statute's still open. And so they could go as far back as they want, or they could go on unreported income as far back as they want too. So my thoughts is it's very interesting what's going on, and I enjoy it because not because there's a lot of work, but because it's really it's very technical, and as well as people are very, very bright in the way they're structuring these investments and movement of money from fiat to crypto to fiat, and back and forth. So it's I enjoy that, so to say the least.
Yeah, look, I think it's interesting because it's cutting edge, right? And I think what we want to really kind of dive into some substance now and kind of talk about what the IRS is going to do in the enforcement. And that's kind of going to be the first part of this webinar. We're going to talk through kind of what we can expect from the IRS as far as enforcement efforts and what they're going to do in order to kind of figure out whether or not there's unreported income or not, and who has it, and how to try and bring those people into compliance. And then, Ray, you're going to talk about really the number crunching here. It's a little bit more nuanced than that, but we're going to figure out how is crypto actually taxed. What are the nuts and bolts? What do you need to report? What is a taxable event? You'll cover that landscape. And then we'll come back and kind of talk about some crypto legislation, what's out there in order to kind of clear up some of the ambiguities that are out there. And we'll talk about some of the IRS enforcement efforts on the John Doe summonses, which I'm going to kind of dive into in a second here. And then there's this willful versus non-willful debate, which is really, really important concept. And look, this is the word willful is the one word I've litigated for the 20 years of my career, both as the government side and on the federal side, because on the defense side, because what willfulness is basically an intentional violation of a known legal duty in the criminal context. It's, did you know what you're doing is wrong and still do it? And that's what carries with you penalties. That's what carries with you severe financial penalties and also criminal penalties. And what the government has a view of when someone's doing something wrong, and obviously the taxpayer has to be looked at from a subjective perspective, meaning what did the underlying taxpayer know, understand, think, realize at the time that they filed their returns, and whether or not in the subjective context they knew what they were doing was wrong in not reporting an asset, not declaring income from one of these crypto wallets or not, is going to be, in some cases, probably the $1 million, $5 million, $10 million, $40 million question, depending on how aggressive the government wants to get with some of the penalties that come into play here. And really, the best way to kind of learn about how the IRS is going to enforce crypto is to kind of look at what it's done in the past. And like I just said before, I do think the Swiss bank enforcement efforts are really the best indication as to how the government is going to come after undeclared crypto wallets. And we can see already them taking steps in furtherance of that. So I kind of go back to the offshore days, the UBS days. And when we prosecuted UBS, they turned over their names. And then from that, we opened up criminal investigations. What made a criminal investigation really was kind of being in the wrong spot at the wrong time. When we got that data, I was up in DC. I remember we put the hard drive into the computer and we just started picking random names, like, let's go investigate this one, this one, this one. And those became your early UBS cases back in the day. But in the wake of the criminal investigation, in which resolves with UBS paying $780 million, it resolved with them turning over the names, the civil side of the IRS, with the help of the Justice Department, served upon UBS something called a John Doe summons. And these John Doe summonses are now being used in the crypto world, which is why I'm giving a little bit of background here. And what the UBS John Doe summons asked for is they said, hey, UBS, we know there are more Americans, we know there are Americans who are not complying with their US tax reporting obligations. We don't know the names of those folks. We just know that they're out there. And we know that there's a common scheme or pattern that you, UBS, know who is behind. So they went to the court in a ex parte, meaning no government, no taxpayer interference, just go to the judge one-on-one, and they say to the judge in chambers, hey, judge, here's the fraud scheme, or here's how money's not being reported. We want to serve a summons upon, in this case, it was UBS, for the information of the individuals. And then the court almost routinely, I don't want to call it a rubber stamp because it's a little bit more nuanced than that. The court then issues the summons and it gets served upon the bank in the case of UBS. And then UBS is obligated to comply with the summons. And they're obligated to produce the names of whoever it is that had a secret Swiss bank account. And from there, the IRS got names and they turned this into a complete audit frenzy. And they audited thousands of individuals who came over with whose information was turned over, and that became really the linchpin to the IRS enforcement, because then the IRS, with all this activity, offered voluntary disclosure paths. They offered paths for those who had the secret Swiss bank account to come forward and say, hey, I had a secret account. I want to come forward before I'm under audit, and I'm going to pay reduced penalties as a result of coming forward, and hopefully avoid criminal prosecution as well. So like from that being kind of the Swiss angle on how the IRS enforcement efforts kind of began and originated and kind of carried out, let's look at the crypto world, right? The crypto world, the exact same thing is happening. So back in the offshore world, there's a Schedule B to the tax return. It asks the question, do you have a signature authority or financial interest in any bank account outside of the United States? Yes or no? Simple question. Yes or no? If the answer is yes and you have it, then it tells you where to file your respective forms. If you check the box no, and you had an account, when we go back to this willful versus non-willful debate, whether or not you knew what you were doing was wrong, what better evidence is there than the simple yes or no question? Do you have a bank account outside the United States? Yes or no? When you check no and the answer is actually yes, you're in trouble. You're now acting with bad intent because you've now lied. And with that comes potential criminal repercussions, civil repercussions. So guess what the IRS has done with the tax return in the crypto world, Ray? I think you know.
I think, and actually on the first page, it goes through the same process of the yes or no. And what's interesting is they're following that same pattern for you to state, did you have cryptocurrency? And if so, how much? And then you go into your whole reporting. If you look at the draft 2022 forms, it's on the very first page.
It's the very top question. It's, have you engaged in the buying or selling of a cryptocurrency during this calendar year? Yes or no? And they are setting this up in what is an area that is kind of nuanced, right? Cryptocurrencies and Bitcoin and Ethereum and whatever other ones that are out there. I know there's dozens and dozens. They've kind of popped up in the last 3, 4, 5 years, and how they should be taxed and when they should be taxed and the nuances of the taxation and how they need to be reported. That was gray because it was new. Nobody really knew what the right answers were to those questions. But we're starting to get clarity from the government as to how they think those questions should be answered. And as that clarity is coming to light, and taxpayers are going to be obligated now to comply with the reporting obligations, that grace period is disappearing. And by putting a question like on the, did you have cryptocurrency transactions during the calendar year, front and center on the tax return, they are setting the taxpayer up for failure if they don't act responsibly. And what is responsibly? It's when you've if you've engaged in one of these transactions and that question is on your return, you talk to the Ray Levy's of the world. You talk to your return preparers and you say, hey, the answer to this question is yes. Now what do I do? Because if you answer no, and the reality is yes, you now are going to be set up for this willful problem. And with the willful problem is going to come all sorts of ramifications, penalties, possible investigation, possible prosecution.
And what most people don't realize is the first witness that is against you is your own preparer, because your preparer is going to be briefed by the IRS CI, and they're going to say, did the client say to you that they did not have any type of cryptocurrency when he in fact said no? So what most people don't realize is that is going to be the first line of defense that the IRS is going to tackle. And to a point, and there's court cases where they have said you willfully said that you did not have it. You signed this tax return under penalties of perjury. So all of these steps are the same steps that the IRS used on the UBS case. And even the IRS uses these same steps, even when you go into a voluntary disclosure that you lie on.
Yeah, look, and I think, Ray, your point about the accountant being kind of the key witness is always the case. Because when I was a prosecutor, it was the first interview I would always used to try and have when I was investigating a matter. We can go to the next slide, by the way, because it was important to kind of get into the facts. And if the accountant was aware of the certain facts, then the responsibility of the reporting fell on the accountant. If the accountant was not aware of the undeclared bank account or the crypto wallet, then you can't hold the accountant responsible for advising the client of the reporting obligations because they didn't know any better. They didn't know about it. Now the government's going to spin this as now they were lied to. So you have like this kind of storm that's brewing out there. And as crypto investment and the wallets and the trading and the buying and the selling increases and increases and increases, the IRS is just going to start seeing cha-ching, cha-ching, cha-ching. They're going to see this as a money grab to try and collect revenue and penalties. And that's really where we're headed. And we see kind of like this jurisdictional gridlock, right? Where you have the IRS is out there trying to crack down on some of the income, but you also have some of these unknowns as far as who's going to actually enforce the crypto exchanges themselves? Who's going to enforce some of these more technical rules? The SEC, is it a security? Is it not a security? Is it a currency? Is it not a currency? How are we going to tax it? These are all kind of questions that the SEC, CFTC, Federal Reserve, they've all kind of like been wrestling with, and you're now beginning to see a coordinated effort amongst the jurisdictional, amongst Alphabet City up there in DC, figure out who's going to police and how. But what is also very clear is the IRS is going to take a very critical role. And we can go to the next slide. Is going to take a very critical role on this because they're going to have to make sure that these are being reported, because there's not better investigators in the world at tracking money and looking for money than the IRS. And look, I want to talk about the John Doe summonses in a bit, because the IRS has issued so far 3 John Doe summonses that I'm aware of in the crypto space. Back about 3 years ago, they issued a John Doe summons to Coinbase, just like they issued a John Doe summons to UBS. The John Doe summons was issued to Coinbase and said, hey, Coinbase, you're a crypto exchange. You have people buying and selling crypto. We don't think that is being reported on tax returns. We don't think that that is actually being disclosed to the IRS. We don't know who your customers are. We want to find out who they are. And they went to a court in California and they got permission to serve Coinbase with a John Doe summons. And then Coinbase was required, after some back and forth, and there was some litigation, was required to produce information related to any transactions which it engaged in which individuals had more than $10,000 in transactions. It's a pretty low bar. And so Coinbase was forced to turn over to the IRS its account holders who bought and sold crypto in more than $10,000 in a calendar year. And that information went into the IRS treasure trove, into the IRS vaults, where now they're matching, just like they do when you get your 1099 from your Bank of America or your W-2 from your employer. They're looking to see whether or not your money's matched on your tax return. Now they know that you have a Coinbase account. And now they're looking at your Schedule 1 or Schedule A, where the question's asked, do you have cryptocurrency? And I say 1 or A because it's changed over the last few years. And they're saying, hey, why isn't this reported? Where is it? And they're starting audits. They're starting audits on those individuals. Go ahead, Randy.
And I think back then, as well as when in the UBS case, they didn't have the manpower nor the funding that they have today. Today, they're talking about bringing in AI, artificial intelligence software, to further enhance their investigation process. And you have already 4,000 to 10,000 agents that are coming on board, and so they're manning up for this process because this is the right time politically. They're going to have a tremendous amount of impact on the financial side with respect to penalties, interest, and taxes. So it's a recipe for a perfect storm.
Yeah, look, and you see from the executive order in March of this year, where Biden is making it a priority. Biden is trying to figure out how to create some safeguards here, some stability here, but also enforcement, right? And look, you referenced the infrastructure bill, which tagged onto it, the 87,000 IRS agents that are going to be coming to the local IRS office near you. They're going to have. They have now the mandate to go out there and do something. So we see that the John Doe summons that was issued to Coinbase was kind of step one to figure out who are those folks with the undeclared wallets, AKA the undeclared Swiss bank accounts. They then followed up in May of 2021 with another with another John Doe summons, and this one to another exchange called Kraken, Kraken. Now, this time they asked for transactions in excess of $20,000. Kraken, again, a very well-known crypto exchange. They wanted to know who the customers were. IRS served them with a summons. Kraken produced that information. And then in this year, in August of 2022, another John Doe summons was issued to an entity called SFOX. SFOX, which is a cryptocurrency prime dealer headquartered in Los Angeles. And they also wanted information for who its customers were who engage in transactions after in excess of $20,000. So what the US government is doing is they're trying to figure out, where is the US hook? Where is the US hook? And with the US hook, how are we going to figure out who has these accounts and who is customers for these third parties? Once they figure out who the customers are, they're going into a database. Once they're in a database, they now are going to be kind of watched to make sure that they're telling the truth, that they're reporting the income, the gains. And if there aren't income or gains, they're at least checking the box that says that they've engaged in cryptocurrency transactions. Because if not, there's an audit coming or a knock on the door from a special agent potentially, and that's not good. And that's where, Ray, I'm gonna kind of turn it over to you.
And Jeff, do you think that, you know, in the old days they said, hey, we think that you did not report to your FBAR. We're going to give you a hall pass and go ahead and report it. I personally don't think that's going to happen in light of everything that's going on, as well as the information that's already out there.
Well, look, just stepping back, FBAR is a foreign bank account report. FBARs need to be filed if you have a bank account outside the United States with more than $10,000 in it. We're going to talk towards the tail end of this webinar about whether or not a crypto wallet satisfies the foreign account nexus to be required to be on an FBAR. Short answer is probably no, but we'll get there. We'll get there at the end. And I guess it's going to depend a bit on the how the wallet is held and all that fun stuff. But the reality is. Right, you want to correct me?
No, just do the next slide. That way.
Yeah, next slide. So the issue though is going to be back in the Coinbase days, in the Kraken days. Once they got the customer list, they sent letters out to a bunch of taxpayers and say, "Hey, warning, file correctly." And they did that in order to give knowledge, because with knowledge becomes the decision to do right or the decision to conceal. And if you're going to conceal, then you're maybe acting willfully. So they're out there beating everything they can in order to try and get attention to those who have these undeclared wallets to disclose what they need to disclose. But we're going to kind of, I'm going to turn it over to you, Ray, now and kind of talk through more of the nuts and bolts of the tax consequences. And then at the end, we'll probably come back and talk about, what do you do if you have a problem? What do you do if you haven't reported this stuff in the past? And there is a way forward to get ahead of it. And that's what's important, is that if you have undeclared wallets, you want to get ahead of it. You don't want to be caught blindsided, because if you're caught on flat-footed, then the government's going to make life a little bit more difficult for you.
I think we've touched base on a lot of these. This is the current legislation proposals on the Senate side, and we're still at a fairly stalemate as where we're at. But I think everybody now is moving towards getting some form of legislation by the end of the year, if not by the early part of next year. Can we go to the next slide? Now, this is basically I want to give an overview, because to Jeff's point, there is sufficient amount of guidance issued by the IRS, and we're not going to get into all of the 16 FAQs. These are most frequently asked questions, but they're there. They actually defined as cryptocurrency as property, similar to a stock or bond. They've laid out the lay of the land of different treatment of taxation on October 9th through a revenue ruling 2019-24. And so what is happening is, again, they're laying the groundwork, you know, for purposes of guidance. So the taxpayer then does not have the excuse to say that it's not out there, or the preparers. For instance, although a chief counsel advice memorandum doesn't serve as a position, it gives you an insight of where they're going, their background, where are they defining all of these different types of taxation treatments, and it gives, most importantly, the information to the taxpayer so they can in fact know their tax obligation. Can we go to the next slide? So the key take, and we could go over, you know, different technical aspect of it, but think about cryptocurrency. No, it's not a currency, although it's a virtual currency. Think about it as a stock or bond. you're buying and selling a digital represented value of that asset. So if you look at it from that standpoint, what we're going to go over is the rules of dealing with what is considered a sale. What's the cost basis? How do you measure costs? How do you measure a capital gains when it comes to a cryptocurrency? Are there limitations on losses? And can you take, for instance, we're now with these bankruptcies, can you take losses associated with the loss of a wallet, a hack, a scam, you lost your key. For instance, if you were in the disaster zone and you lost your key, well, can you take a loss? So we're going to go over that. This is basically the definition. Next one. So the FAQs, it really, and I've highlighted in green, for instance, is the currency payment for services that you've rendered. Yes, you have to include it for services, and it's ordinary income, is not capital gains. Do you have capital gains or losses in exchange of virtual currency with other property? Yes, you do. The IRS has been specifically, we get calls from clients that can I do a 1031? Cannot do a 1031 because you're really not exchanging a virtual currency for an equal virtual currency. So the definition of property is a critical point when it comes to this. And then the last one on mining and you're receiving. So there are clients out there. So for those that don't understand mining is when an individual buys a series of computers that enables these computers to be utilized for purposes of safeguarding the virtual currency. And in this particular client, they got paid with virtual currency. So we basically, that is a realized ordinary income. It does not take away the fact that she still can deduct the expenses as well as the equipment to buy to service those virtual data centers. So the critical point there is determining whether it's passive or non-passive, and that is something that we could discuss, individually, because it's a whole slew of questions and answers there dealing with hours and whether you participate in a trader business or not, or is it passive. And then the last one, which is we're not going to get into, but and that is the sales tax on some of these items, especially if it's a product or a service. But you do have to pay sales self-employment taxes. Most people do not believe they do, especially if you're in a trader business. The other point is if you're a trader, that you also have to pay self-employment taxes. So traders are a different breed, and that, think about, again, going back to my original example, is if you buy and sell stock as a trader, there's certain elections that you have to make. There's certain measurements of how you measure your trades. And by the way, it's not a capital asset. As a trader, the cryptocurrency that you buy, it becomes an inventory. So that's why it's ordinary income. Go to the next one. Again, these are specifics in terms of, and this goes back to why, going back to what Jeff had mentioned, is why I believe there is sufficient amount of information out there for tax preparers and individuals that are engaged in the preparation to assist clients in making sure that they are complying with the IRS pronouncements dealing with the taxation of cryptocurrency. Most importantly, since we do a lot of international, we get clients that tell us, do we have a backup withholding on a cryptocurrency that I've sold, and I'm a foreigner, I'm here in the US, I'm trading. So those are questions that you got to look at, but for the most part, we do a backup withholding, and yes, it is required. Because why? It's considered, if it's a trader, it's considered service. This is an interesting, so for the benefit of those that don't know what a hard fork is. So let's say, for instance, that you have we have merge right now, and let's say a digital ledger splits into two, and now you have a new set of digital currency. So you may get one digital currency for your other digital currency. So that is where we have a fork. Think about a fork in the road where you have a diversion of your existing distribution ledger. That soft drop, which we call a soft drop, basically is taxable because you're getting a currency for really nothing. So in essence, that's a taxable event. And it's, the Supreme Court has pretty much nailed what constitutes a gross income. I'm giving you the case there, but it's very, very constructive. You received it, so you have to pay taxes on that. Next. This is an interesting aspect because this one, we're going to get into what we call as what is the types of ways of which you can in fact determine your cost method for purposes of your crypto sale. So I want you to also understand that we're talking about these methods that are applicable to the United States. If you go to UK, they have a different set of rules as to what they do their cost method. If you go to Australia, so when you're applying basically the cost method of determining, you need to realize, because you may get bombarded with a lot of information, but you're applying what is acceptable method. These are the acceptable methods. So the most interesting one that is different, and I'm sure that most of you have been involved in stocks and the sale of them, you understand LIFO and FIFO. So what the IRS has set forth is you could actually do, and this is all governed by a software where you could take and really select from every single basket of currency that you're holding in your wallet and specifically identify each time that you're disposing a crypto asset, and you're identifying which one you're selling, and it's almost like the deemed sale of that. For instance, you may sell, a certain percentage of this particular crypto in your basket. So what this does is it basically manages the date of which you acquired it. It goes to the fair market value, the date of each time that you sold it, and the fair market value that you sold it for. And what it does, it keeps a running tab of what each basket of specific lot you assign to a specific crypto basket. And it's something that I would tell you right now, even as a professional that we're involved in this, there are softwares out there. You simply have to keep the details of these 4 components. If you don't keep the 4 of these components, you cannot apply this method. So that is the first one that you got to look at. The second one is what HIFO. HIFO is a use basically that you must meet these methods that I just mentioned, but you take the highest cost, and which obviously the highest cost in this environment, you're looking at people that potentially bought cryptocurrency at a very high, it's gone down. This will result in a loss if you're sitting on gains that you resolved. So it's a very interesting, what we normally recommend to clients is basically run all 3 examples, because most people apply the FIFO method. The FIFO method is basically, that's your default. That if you don't keep track of the 4 methods, that is what you're going to use. And that's basically your oldest bought coin cost. And that's what you use to match to your current. Now, in this environment, obviously, crypto has gone down, I think 16,000, depending upon which coin, which ones you have. But in essence, I would run all 3 of them to basically determine what is the best results for your tax year.
So Ray, just to jump in here, look, I have a Coinbase account. Don't worry, I check yes on my tax return as well. But I've always found it interesting because, like, I know how much interest I earned on my brokerage account or what my gains were for my investments from Morgan Stanley every year. They send me my 1099. I know exactly what it is. On my Coinbase account, and look, I only buy, I've never actually sold, so that means it tells you a lot about my mentality. But I like it's never there as to like easily for me to figure out, hey, my gains to year or my return on my investment or the profits I made aren't there in black and white. And they aren't obligated, I think, until recently. Some of the new legislation is going to start requiring them, I think, to do some sort of like 1099-like reporting, the Coinbases of the world, so that I can see, look, here's the cryptos I bought, here's the cryptos I've sold, here's what my profit and loss statement is for the year, and then I can give that to my accountant at the end of the year, like I do with my Morgan Stanley 1099s. This is all, I think, going to simplify as things move on, because I think the exchanges, at least the US-based exchanges, are going to have to start doing more reporting moving forward, which is going to make life maybe a little bit easier.
I think it's going to make it easier for anyone to understand where they are. Most of the exchanges are providing softwares. It's an additional cost, but if you're savvy, there are actually apps that you could download, and you could determine that. So they're definitely going to get, because you're right, we get this, just every single sale, but they really don't tell you really a lot of information. So a lot of times we have to pretty much rebuild the information to come up to a cost basis that we can in fact match. So for instance, in the early part of the cryptocurrency, where there was a significant amount of gains, for us, the HIFO and the last in first out were actually the best methods to reduce the capital gains at the very end. So but again, in this environment, we're looking at losses depending upon if you sold. So my recommendation is to run these types of, whether it be your tax ID method or your HIFO or your FIFO. So,
and look, the other lesson I learned from hearing you talk about this, Ray, look, this is why you're the accountant and I'm just the blowhard lawyer, right? Is that you need to make sure your advisors know what you're doing. You need to make sure your advisors know that you have been traded or that you bought or that you sold, and give them the paperwork that you need to substantiate it. And then look, because it then falls on Ray, you and your team, to figure out the right tax consequences. And that's going to take me, the taxpayer, out of any penalties down the line or prosecution down the line for not doing things right. Ray, you're allowed to make a mistake. That's not going to be the end of the day, because me, the taxpayer, have made full disclosure to you as to what my activity was. Where you're going to get into trouble is if you just don't tell your accountant you did this at all, and then hope that no one ever finds out about it.
Yeah, I think for the most part, what we're seeing in a lot of taxpayers, that they don't understand that there's different methods. They're coming from possibly another preparer that does not understand. So when we get into whether, in this slide we talk about the tracking. The tracking is so important, because you're almost creating different, for each coin, we're basically setting up a cross-reference of a wallet. So we're able to know each tax lot method. And that is an interesting way of doing things, because in essence, what most people don't realize is that the specific method achieves really the best results a lot of times. And it doesn't matter really which, you just have to make sure that you are picking and being consistent on the tax lot method. What's interesting is the IRS has not had any type of guidance with respect to the specific identification or how to do it. They are in fact telling you have to keep track of how you calculate it. You have to understand which wallet you used to calculate your cost method. There has to be a methodology that you're employing. You just can't sit here and say, I think I paid so much for this crypto, this is my, and this is what a lot of people do, by the way. They just select a cost method that is the least capital gains without a methodology behind it. So, you have the universal method, and then you have the per wallet method. Per wallet method is a more comprehensive. We use those a lot for traders. The universal application is for people that are in the business of simply, buying and selling, but they're not really traders. Next slide. The contrary to stocks, and we all know, maybe we're consulting all of our clients now, or maybe 15 days ago, hey, you got to take your losses. Wash sale rules are not applicable to crypto. Now, you still have limitations, right, as to what your losses are, but the nuance of a way for tax harvesting, that is extremely important, especially you have until the very end to really determine what your tax liability is going to be, because you're not applicable to these wash sale rules. Now, this is the interest deduction margin accounts. Let's assume that it is truly a margin account, because a lot of people are basically telling you that it is a borrowing, and actually what they've done is they've switched it to one other wallet and they've cashed out. But assuming that there is a margin interest, it's the same. I believe it's section 465, where you have to determine what did you use that margin for, whether you margined and took the money out and did something else with it, whether you use in fact to buy, what were the proceeds used for determines your deductibility on the funds borrowed. Next slide. So so far we've mentioned everything that deals with that the IRS has addressed the taxation for the most part of everything, and they've given you guidance through revenue rulings as well as CCAs. Where there is an interesting case that took place in Tennessee, and this case is the only undefined taxable event where you have a couple that basically developed the creation of new blocks of tokens. In essence, in that blockchain, they received token rewards. Initially, they filed and they taxed that money. Then they filed an amended return and requested a refund back. The DOJ came in and contested, seeking, why are you getting this refund? Then the DOJ then took back and allowed the refund to go forward. This is an area that needs guidance. I will tell you my train of thought, and that is, they're looking at rewards. Well, if you, for instance, charge a credit card and your American Express, not to mention any particular company, or your MasterCard, and you get points, we don't get taxed on those points. So because of rewards, and I think that's a slippery slope that the Department of Justice may not want to go into, and so we need clarity on this area, because quite frankly, if we don't, then in any type of activity involving stacking, then the reward is not, at this point in time, is not taxable. So it's the only thing that's left. Now, fundamentals of tax concept, and you will understand that why, as we proceed forward, and why fair market value, that it's really have to be sold in an open market. And so you're determining, very simple, no different than you sell your stock in the stock market. You're selling a cryptocurrency. You determine at the date that you exchange your fiat for that currency. So that's your fair market value. The cost method, as I mentioned before, includes the cost as well as any type of transactional fees that you're involved in. So think about the aspect of your buy and sell of stocks with some nuances in terms of, you want to make sure that you keep track of the fair market value when you so buy your crypto fiat. Capital gains, again, think about it, and I don't want to downside, but I'm saying, think about your sale of a stock. You're basically going to have short-term capital gains, short-term capital losses. You're subject either to your normal rates that go as high as 10 to 37% plus 3.8, or your long-term capital gains that can be 0, 15, 23.8%. But again, if you're keeping track of when you bought that crypto, and going back to the illustration that I said to you, whether you're using the specific tax ID, the HIFO, the FIFO, then this is critical, because you're then going to determine what is your basket that you're really clearing, whether it's a long-term capital gains or a short-term capital gains, or vice versa, a long-term capital loss or a short-term capital loss. So it becomes very critical as to your buy dates and your sell dates. And this is why I always say to people, run the methods the best way. Then you're able to not only optimize in your loss in terms of netting against your gains, but most importantly, you determine what is in fact long-term, which you reduce your marginal rate to a much lower amount as opposed to a short-term. Here we basically set out explaining here, like for instance, selling a crypto for a fiat. That's basically, you're going to be taxed that as ordinary rates. A gift, if you're sending a crypto gift this year, you know, it's anything over 16,000. That would in fact be a taxable event. Purchasing or buying goods and services, we're seeing that a lot in South Florida in the restaurants. We're seeing that a lot with the service sector. That's all going to be taxable. Buying and trading one digital asset for another, again, this would be a non-fungible or fungible, as well as using cryptocurrency. That also would be subject to basically ordinary income or losses. But again, you have to determine whether you're in the trading business or not. What's interesting is, and I think most people don't know, is that the IRS is not accepting a loss associated with claiming your loss as you lost your wallet, you lost your key, you send it to the wrong account, you got hacked, there was a scam. That could potentially change. You know, there was with the Madoff case, they specifically passed a revenue ruling that allowed, because the scam was so large, that it allowed people to go back and amend their returns and be able to offset those losses that they incurred. And simply saying, you're not to take your loss, going back to the definition, and that is you didn't really have a sale. So the IRS's position is, well, how do I really know whether you really lost it? How do I know that you really really lost your key? And maybe you just diverted it, and now you have it somewhere else, and you're claiming the loss, and you're shifting the asset to another wallet, and you're doing it. But there are some tax planning with respect to these as well as the abandonment. I would suggest it's a facts intensive analysis. And that's why I put down here, in essence, you've got to look at the facts and facts of the case, because, for instance, we have a client again in the Ian disaster. There are some components of disaster relief that you can attack and take a casualty loss. So that is something you got to look at, but there is no losses as it stands right now, because pre 2017 Tax Act allowed it, post did not. Now, let's keep in mind, post is 17 through 25. After 25, they're going to have to come up with new rules, and neither.
I litigate that one all day long. I feel like if you had, I like, if the facts support it, I would encourage you to discuss with your professional and not be afraid to take it, because I think at the end of the day, there's losses there. If we're gonna have to pay on the gains, we should also be able to take advantage of the losses and general theft and casualty rules that are out there for other types of assets.
And that brings up a point, because what we've said is, do we disclose on the Form 8275 that we're taking that position, as opposed to simply take the deduction? We normally have opted to do the 8275 on the disclosure of the position, as opposed to just simply taking the loss on the forms, to avoid any penalties. This is basically, this is a interesting so on the infrastructure bill, they actually went ahead and did a provision on what the digital assets is, and they actually defined it. But what they did do is they standardized that every exchange coming now, beginning in 23, which means in a couple of weeks from now, all of the activity that you buy and sell in 2023 is going to be collected, and ultimately it's going to be reported. And they also instituted, and this is very, very big in the jewelry business and businesses where they're involving, and what's happening is certain businesses are substituting cash or a combination of cash and crypto in order to basically reduce the reporting requirement of what I consider to be a structured transaction, and that is the 8300. So they're really beginning to understand the abusive component on the buying and selling of products, as well as they're now forcing the exchangers that basically are going to have to come up with the 1099-B and report the customer. And not only the customer name, address, and what the trades are, and what they made during the year, similar to a 1099 that the brokerage houses do.
And look, on the 8300 front, look, this is a form that gets filled out when you receive cash in your trade or business, right? So they're basically going to start treating Bitcoin or other cryptocurrencies as if they are cash. And again, the failure to follow these forms could lead to criminal penalties if done intentionally, and civil penalties as well. So I think what the IRS and FinCEN, which oversees the financial reporting on the 8300, are looking to do is just trying to create enough of a track record here to show, here are your obligations, here are your obligations, here are your obligations, and begin to really treat it like cash. The IRS hates cash. It's harder for them to track cash. They hate crypto. It's hard for them to track it. They're going to make it easier for them.
Yeah, and there's even questions that have not, for instance, title companies are required to report cash transactions at this point in time. So now, if a title company and a person is buying real estate, and there is a digital asset in play, the title companies are going to be obligated to report that too, because it actually defines as digital assets being treated like cash. So South Florida is a specific targeted area that actually reduces the thresholds from the 10,000. So it's going to be interesting. There's certain markets, New York, South Florida, that they're going to be targeting this on the 8300 side front too. This is basically, we're dealing here with penalties, and I put this out there at this point in time. This is the penalties that they have. What I want to home in on is really the last one, and that is a willful violation. And the willful, again, going back to what Jeff is saying, again, this is the actual exchange. The exchange is required to report. So here we're forcing exchange, and they're putting a lot of penalties, and then they're taking it to a further, and that is that person involved or guilty in essence of not reporting this? There are also, keep in mind, there are people out there what they call investment pools. So they'll put up and they'll say, Jeff, I'll give you 100 grand, and we'll give you, and you're going to trade on your account, and now you're going to trade for us, and you're going to make $100,000. I share in 35% of that. Jeff is then be obligated on his side, once he receives that, to actually give it a 1099 on that investment pool to the people that shared that. So, and there's a lot of people that do these investment pools. So I've seen 6 or 7 of them already in the twos of $5 or $6 million. So you have to keep that in mind, that that corporation or that entity would be in fact obligated, not just being the broker, because the broker is going to report the entire amount to that entity or that individual. And that individual now has to issue then 1099s to the rest of the individuals that they're participating together. Next. So this is, I want to, and we're going to circle back as to why we're talking about the 8938. The 8938, and we've delineated into 2 parts. Right now, as everybody may or may not know, you're required to report your total value of foreign assets. And so you may not have a FBAR requirement, but you may in fact have a 8938 requirement, because you have to disclose the value of that crypto asset that you're holding. And it goes into what thresholds you need to have, and you will see is that there's a different threshold for living in the US versus living abroad. So the living abroad is more generous and allows you, but just remember, you cannot eliminate the need if you're living abroad, and we'll get into what we call as the whether you have an exchange that's outside the United States. You may have a combination of both FBAR and the 8938 too. So that is a component, because a lot of people are saying, well, I don't have to do FBAR since at this point in time, it's not required. Well, you have a foreign asset, especially if it's sitting in a foreign exchanger. I know you have a lot to say on this, so Jeff, but I basically pointed out that it's not clear, and they haven't. They issued a notice 2020-2, and I think 2020-2, in my opinion, sets the stage for the next phase of the requirements for an FBAR, because it's going to you as an individual that buys and sells cryptocurrency, you're going to have to determine whether your exchange is offshore or inshore. Now, let's understand that we're dealing with in a digital asset world, where potentially your digital coin is maintained in multiple jurisdictions as basically the data centers. So my conservative approach that I'm telling my clients is, out of abundance of caution, let's report the cryptocurrency, because if you have an international exchange, you're going to have to do that. But how do you know that the current exchange here is not utilizing, unless you have your wallet and your key in your possession? But if you have the $11 billion people that have, like FTX, that are unsecured creditors, you don't know where those cryptos have been parked, and you don't know where they are in a world. So out of abundance of caution, we're basically reporting even cryptocurrencies. We're asking the exchangers to tell us whether they've have lent this to another exchange and they're receiving interest, or whether this exchange is being parked in another exchange. As we're seeing right now with FTX, we're seeing that these exchangers are all talking to each other. There is an enormous amount of collaboration between them. So you have to be really, really careful of at least as a tax professional, when you tell a client, no, you don't have to report an FBAR, unless you're secure 100% that this is a domestic exchange. If it's an international, the position is you should in fact report it, because it's sitting on a foreign bank account. It's sitting in an international bank account. So I know, Jeff, you had you wanted to talk about the FBAR component.
Yeah, look, I think I think your analysis is right, that it's all about whether or not it's foreign, right? That's a foreign bank account. Is it then a bank account? I guess it depends how it's held and how it's titled. It's going to be a little bit fact specific, depending on the exchange in which your cryptos are being held. What I do think is telling, though, is that when they came out with this notice in 2020, talking about how they want to maybe create new reporting requirements for virtual reporting, to me that tells you that you don't need to report it today. And they need a legislative fix in order to make it apply. Now, obviously, if you fit within the existing definition, that's a different story. But I think we're going to see in the coming years, instead of the foreign bank account report, FBAR, we're going to see like the virtual currency account report, or the VCAR. And the VCAR is going to require you to disclose your wallet, what you got, where you got it, how much it's worth, all those types of things. That's not legislation today, but as we see government just kind of over-governmenting everything in life, you can see that kind of percolating and being part of one of these new legislative fixes, especially in the wake of the FTX stuff.
Yeah, and let's keep in mind, once it falls under the FBAR regime, you're talking about now criminal. If you're willful, now you're basically getting into an environment. Why did you not report your FBAR? And that's going to be the argument by the government. And so you got to look as to what's happening on the guidance. You got to look at what's happening on what the intent of where the IRS is going. I think that we're going to see in the coming year some form of disclosures dealing, because they are already setting the stage on the tax returns on the forms. So now the second one is, where do I take it? I mean, if I did a virtual, it either goes to my Schedule D or my 8938, but if you still have it, it's gonna go to the FBAR. So it's almost going down that very same, standardized process.
And look, that's what's so frustrating is like, what form do you have to report it, and which time and which date, and to where does it get sent? The government's all over the map. And as it is so complicated, it becomes more difficult for the government to argue that people are skirting the rules intentionally, right? Because I think in a lot of the offshore space, you can intend to do right, but because there's so many forms and so many rules and so many pitfalls, you may not do it right, even if you're trying to do it right. And whether or not the government has that sympathetic ear in order to understand the difference between the taxpayer who's out there trying to hide and cheat and conceal versus the one who's trying to do right. That's where, Ray, you and I make our money, litigating those issues when the government starts questioning.
Yeah, next one. So here's an example, and by the way, does not include all exchanges, but look at the difference of non-US based foreign exchange versus the US. So if you were an IRS agent and you were looking and says, I have companies in the Seychelles, I have companies in Singapore, Hong Kong, jurisdictions that in itself have in the past served some way or form assistant of tax evaders, they're going to look at this and say, listen, this is a foreign exchange. You're holding an account in a foreign exchange. Consequently, we believe that's these exchanges are going to be subject to an FBAR down the road. If not, you have, in essence, you have a foreign asset. You do have a foreign asset of which you have to deal with the 8938 at a minimum. Okay, but it's going to be an interesting component, because understand this: if they pass legislation in 2023, if you haven't been keeping track of all of this, you're going to spend tons of time and energy to determine at what point was the highest account. And that's basically going to be going through all your trades, and so it behooves every taxpayer to really consult with their professionals to really understand if you want to avoid problems down the road. Folks, we're talking about information reporting. We're not talking about income tax. So the IRS's position is, listen, why would you not want to report? This is information reporting. We're not asking for anything else other than the information. So I really believe that this is where they're heading at down the road.
I think that's right. Look, we're wrapping up, or we're coming close to, or at least the presentation part. We're gonna move to Q&A, but we want to talk, like, there's legislation out there, right? The future's a little murky. Obviously, the Republicans gaining control of the House, the Senate remaining in the hands of the Democrats. You have Biden, who's looking to make this priority. Where the legislation goes really is anybody's guess, because there's so many competing interests here, all fighting for, I think, the gavel here, so to speak, or for really the direction. But I do think that one thing is clear, is that from an IRS enforcement standpoint, the legislation is going to get more severe as far as the amount of reporting and the type of reporting. And as time goes on, like everything else in life, the government's going to become less forgiving of foot faults, of mistakes, and begin to become cynical and think that these foot faults and the mistakes are intentional wrongdoings. And as those intentional wrongdoings manifest over time, and if you get caught in the audit or get caught worse on a knock on the door from an IRS special agent with the undeclared wallet, then we're going to have to deal with some real hard questions as to why things weren't done right. And I guess that kind of, I want to just, before we go to questions, there is voluntary disclosure programs out there. There are ways for folks who have these undeclared assets to date, just like there were for the Swiss bank accounts, there are for the crypto wallets as well. There is a path forward as far as cleaning up wrongdoing. And by cleaning up wrongdoing from the past, you are going to avoid or mitigate criminal exposure and penalties. And that's the bottom line. And while there was a formal program for the offshore bank accounts, there was a formal program in which you had to go through multiple steps, you had to pay certain penalties. That program doesn't exist today for the crypto space, doesn't exist today for the offshore space either. But there are still manners that come forward. We do voluntary disclosure work all the time. We bring people out from the cold into the light, and it allows certain folks who have these problems lurking in the backgrounds to come clean, to do it right. We work with the forensic accountants, we work with the peel it back, understand the tax consequences, and then make informed decisions in order to mitigate risks.
Yeah, and I think historically, even if you look at the House that's been by the Republicans have been forceful in the area of information reporting, but yet maybe tweaking the thresholds of what they're willing to be reportable, to exclude the smaller guy. But they have been consistent on that. And I think that if you look at the senator from Oregon, he is adamant, to basically get something rolling. Because
Senator Wyden's like our new best friend. He as far as enforcement goes. And for those of you who are in South Florida, you should come to the FICPA Florida Bar International Tax Seminar, which is in January. And we're going to have someone from Senate Finance actually speaking at the conference, where they're going to be able to talk through kind of what's going through the investigative mind there and what their priorities are from the Senate. I'm sure crypto is going to come up because it has to.
So we're going to open it up to questions now, and
look, it looks like, Ray, we have a good number of questions already.
Yeah. There's one question, Jeff, and that just came up, and that is, what's the time frame between based on your history, what is the time frame between the time that they the John Doe summons, and in fact, when did they start pursuing that criminal, or in essence, the process would be, are they willful? Do we have a candidate for a target? Can the target be, do we have a grand jury indictment? And then further, what's that time frame that these taxpayers have, to really make a decision whether they want to clean their act or not?
Yeah, look, it's a tough question to answer because there's no real answer, right? It's really fact specific. I go back to my days in government, and look, it was 10 years ago, and I'm sure things have gotten a little bit more efficient in a lot of ways, or maybe they're less efficient now than ever. Who the hell knows? But it was kind of random, right? So the UBS list comes to us, and how fast we were able to put people into the system in order to block them from doing voluntary compliance was really how fast the special agent sitting to my right was able to log into the systems and do these things. I'm sure when it comes to the John Doe summons, to Kraken, to Coinbase, to SFOX, and wherever the next one may come, it's going to take a little bit of time for the IRS to process that information and figure out whether or not people are going to be under audit, under investigation, or whether they can do a voluntary disclosure. So there's no really good answer. All I know is that if you get to the IRS before they get to you, there are benefits that are potentially out there for you. And that window is anyone's guess. We gamble with that all day long when we do these disclosures. You just have to trust that you're doing things that by coming forward before you've actually received a letter or a knock, you're going to get credit for it down the line, wherever that credit may be. And I think you do. My experience is
they're basically on the pre-clearance for, let's assume you want to go into some form of voluntary disclosure, and the name, normally you have to go through a process what we call the pre-clearance, where I give, let's say Ray Levy gives his name, and they look through this list. In light of everything that's going on with these John Does, do you think that list is going to come back to bite a lot of people because they really, or do because if they get the name already, will they get that pre-clearance?
I think if they get the name, the IRS is going to do something, especially as they've now been given all this money and been told to beef things up. So I think when to do the pre-clearance, I think you do it as soon as you think you have an issue that needs to be reported, and going into the voluntary disclosure program is the right way for you to clean it up. So look, there's no good answers here. We've seen DOJ act rationally, irrationally. The IRS act crazy in some of these cases. But the bottom line is, if you have a problem, raise it with your professional. Raise it with your professional, and hear options, and try and get ahead of it. I know I sound like a broken record there, but that's the bottom line. Yeah.
The other point is, there's a lot of people that have had, Chapter 11 bankruptcies that they've lost their funds. I know that they've lost their key. The IRS has come up some guidance on this already, but what's your take on it? Because I do know that you could take the position. You just have to make sure that you advise counsel as to the process and how, whether it's disclosed on the 8275. And for purpose of those people that don't know what 8275, you're basically telling the IRS, I'm taking this loss and I am giving you that I am, because I do not want to get hit with penalties should there be an audit and the position goes against me. What's your thoughts on that, Jeff? On the ability to take the loss on either.
Look, I think when you have these ambiguities, the key is to be transparent and take the position most favorable to the taxpayer, and be transparent as to what you're doing. So that way, if the IRS has any questions down the line, and chances are they won't, but if they do, then at least you're able to say, look, I highlighted it here. And what that does is at least now lets you debate this on the merits, but it's going to remove penalties from the equation because you've been transparent as to what it is your position has been. So if you got the loss and the facts say you can take the loss, I'm okay taking the loss. Just disclose it, put it on the right form, make it clear as day as to what you were doing. I see we do have some questions on like FTX, the bankruptcy, and how this is going to impact folks who've lost money. And I think the one question is, Jeff, are investors in the FTX bankruptcy now IRS targets for non-compliance since they will be listed as creditors? Look, I think if you are in a publicly filed document having lost a significant amount of money and you've never disclosed the proceeds of that buy sell of your crypto over the life of your exchange or the life of your investments, then you probably want to be a little careful. I think you do want to probably clean it up on the IRS side once there's a publicly available document out there to say that you had money there. If you have gains, go back and report them. I think you want to talk with your professional, understand the why and the how to do that. But it's an interesting issue because, look, I represent whistleblowers as well in my practice, and we're always looking for publicly available information to kind of help bolster claims. And this is one that I can see a creative whistleblower going there with that list and saying to DOJ, hey, run with this. Now, DOJ or IRS may look at that on their own. I don't think I see it as criminal liability per se, unless we're talking about substantial amounts of money. I think you're dealing more with an audit.
Yeah, there's a question here whether stacking is similar to mining. No, the IRS specifically has addressed mining income. Versus stacking is basically a court case in Tennessee. Now, keep in mind, Tennessee, for instance, we are the 11th Circuit our 11th circuit may be different than the 5th circuit and other circuits. So we're saying that as it stands right now, if you're involved in stacking and you get rewards, then that case is basically pointing to us that the rewards are not taxable. Again, you should consult. It's the Jarrett versus the DOJ, and you could take a look at that. But mining is clearly already out there and defined. They're not similar. I mean, I understand you're saying similar, but it's not similar because you're getting paid. You've bought equipment. You're providing equipment. They are utilizing your equipment. You're getting paid mining income. So that would be a function of ordinary income.
So another question is that crypto is extremely popular with the very young generation, some of which may not even have otherwise tax return reportable activity. Is nobody safe or only the bigger players? And look, that's a question I get asked all the time is there a threshold? Like, can I cheat on my taxes, but do I have to have cheated on my taxes by a certain amount before I become a real problem? And the answer is practically speaking, they're not going to be going after small fish. They're not going to be chasing tens of thousands of dollars. But you see what they were doing in the John Doe summonses. They wanted all transactions in excess of 20 grand. So there's no real dollar threshold. When the IRS enforcement perspective, from the Justice Department enforcement perspective, they want to go after a little bit of everybody. They want to go after the plumber, the dentist, the doctor, the CEO, the CFO, the return preparer. They want to go after everybody they possibly can in order to send messages out there and deter others from doing wrongdoing. So I don't think practically speaking or pragmatically there's a dollar threshold, but the reality is that there has to be significant tax loss. Uncle Sam has to have been defrauded out of a significant enough money for there to be some real concern from the government there.
There's some questions dealing with a Ponzi scheme. Well, you know, the IRS, like I said, specifically identified the Madoff case as a Ponzi scheme. If you're having losses and there is a matter of which it's declared a Ponzi scheme, then you have to wait until the IRS rules on that. But as it stands right now, your losses are limited to $3,000. You know, so and if you're a trader, that's a facts and circumstances. I'll be more than happy to, but then we would have to see, in fact, are you a trader?
We got a question about the check the box question, because it's funny that when you read the actual check the box question, it simply asks, I don't have the wording right in front of me right now, but it's like basically, did you engage in virtual currency transactions, buy or sell? It seems pretty generic. And then you peel it back and you look at the instructions to the form, and the instructions kind of complicate what I think is a pretty simple question. And they basically create a little bit of this ambiguity as to when you need to check the form. So the question is, do you always check the form or not? Look, I read the question on its face. If I see it and makes sense, I'm checking yes. I'm not going to try and bury a little bit in the weeds, which kind of is interesting because I see another question we have is, it seems to be contrary to my position as to whether or not to file like an FBAR for protective purposes or not. I think there's always good to file a protected FBAR. If you feel like you need to file such one, it is going to help the argument down the line. But I also don't like filing things just for the sake of filing things. I think you really need to look to see whether or not you have the obligation to file, and if so, file.
Yeah, and I think, you know, to go back to that question, I mean, it's almost, did you trade crypto, a virtual currency, yes or no? I mean, you can't get into a situation of trying to slice hairs, because that's just not going to go well in an IRS line. You know, so a lot of times I know the instructions are somewhat convoluted and difficult, but the reality is, did you trade a virtual currency? Yes or no? And if you did, then check the box and report it on the appropriate forms.
So look, I think we've gotten through most of the questions.
The casualty losses and dealing with whether it be a casualty loss with a lost key, lost wallet, that's again, that would be a facts and circumstances. And again, I've taken the position to basically take the loss, but I've also disclosed on the 8275. you know, and that, again, that was under counsel's advice. 99.99%, we do not get involved in that determination. Counsel gets involved in that final aspect of it. And when I say counsels, would be like Jeff Nyman, you know, that he's basically looking at the facts and circumstances.
Yeah, I'm not sure if I'm the right one there, but we'll find you the right person if I'm not.
Someone's saying, why is losses limited? Remember, this is stocks. This is a property, you know, if it's a property and this is a capital asset, your capital assets are limited to $3,000 loss. You net your capital gains and capital losses, but at the end, it could be an ordinary loss. Your ordinary loss is limited.
So I guess we have a question about how do you know if an exchange is foreign or domestic? I know you got a pretty detailed list there, Ray, of the ones that we know about. Look, I think you just ask, document that you ask if you need. But I would look at the FAQs or wherever it is you're trading and just ask the question and document you've asked it. That's a good way of dealing with it.
I mean, I'll give you. You just have to ask the exchange. Do you have offices in the United States? Or is there anything that, for instance, that has you not regulated, but you have offices, and are you considered a foreign exchange doing business here or not? You have to ask the question. You just can't say, I did not know.
And look, another question we asked is, do you recommend just leaving the cryptocurrency question on the return just blank? If you leave it blank, you can say you didn't see it, I guess, but now you got to convince somebody you didn't see it when it's right there as question one. I think you do your best to answer the questions truthfully and honestly. And I think what you do is you disclose to your return preparer exactly what's going on. Take their guidance of whether or not you have to check yes or no. If you're in trouble, you want your return preparer's work papers to show that you gave them your Coinbase account trading activity. And that way they can say that you can say that you gave them the information and you followed that advice. And that's how you avoid willful penalties and criminal prosecution.
Jeff, let's assume somebody files a return and they did not answer the virtual currency.
It's just blank.
Yeah.
Yeah, look, it's better than lying. It's better. It's an omission now as opposed to an actual lie. But look, it's still right there. Yeah, it's still an omission.
Yeah. So I think, and I think you really have to be careful of playing coy with the Criminal Investigation Division of the IRS. And keep in mind, we have a lot of agents right now. They're looking everywhere. So I'll give you an example, and I know we have to basically end because we're almost out of time. We got 1 minute. In the past, CI would not look at anything less than $5 million. They didn't want to touch it. You know, it's just too much. Now, if you don't think that they're going after, look at the Department of Justice, the amount of cases that they're publishing. I mean, and you'll see that there are cases they're going after that it would baffle you because
it's a mess over there, but it is what it is. It's keeping us busy. There's no rhyme or reason, but look, we're out of time. I'm gonna shut up. But Ray, thank you so much to you and Rose and your team for inviting me to join you all today.
No, we want to thank you all. I know that there's more questions. We have a limitation of time. You could always feel free to send us an email, and we'll try to do our best as possible. And thank you very much for all of you participating.
Thank you to our amazing audience, and thank you to our presenters today. You have their contact information over there in your screen. You can also contact us at info@abitos.com. We'll be more than happy to assist, and we wish you a very nice weekend. Thank you so much for your time and for staying with us so far. Thank you. Have a nice day. Bye.
Jeff, take care. Bye-bye.
Bye. Thank you, everybody.